Investing in stocks is one of the best ways to build wealth. But anyone who's owned a stock for more than, 7 seconds knows amazing how it feels when your favorite stock goes up, or worse, how horrible it feels when it goes down. Did you know that studies have shown that loss is twice as powerful psychologically than gains? It's true. A loss of, say, $100 is about as powerful as a feeling of winning $200. Let that sink in for a second. Now, I don't know about you, but maybe that's why I remember all of the crashes in the 20 years that I've been trading stocks and options. But what if there was ways to protect you from the stock markets moving down without having to take massive losses, or worse, lose your stock positions? Well, there are ways, and that's why I created this video for you today. Today, you're going to learn 2 super easy ways to protect your portfolio from a market crash by using options. And in some cases, you can even profit from it. Oh, and by the way, if anyone ever asks you where you learned any of this stuff, just tell them that you subscribe to Rick on YouTube, and by all means, feel free to share the video with them. Okay, first off, before getting into the strategies, let's brush up on our options terminology. Now, if you already have a good idea about how options work, feel free to skip ahead. Options have 3 main attributes. It's the underlying asset, which could be the stock that it's tied to, the expiration date, which is the last day of the contract, and the strike price, which is the trading price we want the stock to either stay above or below before expiration. The underlying asset, strike, and expiration will all differ based on what you're looking to achieve, and of course, your outlook on the market. So there's 2 types of options available: call options and put options. Call options give the buyer the right to buy the underlying asset at a specified price on or before expiration. Put options, they give the buyer the right to sell the underlying asset at a specific price at any time before expiration. And when you buy either a call or a put, you pay a fee. This is the premium. And when it comes to options, or at least on options on stocks, each contract represents 100 shares. So one contract means 100 shares on the stock. Buying a call option means that you expect the underlying securities price to increase on or before the expiration date. Now, the person who's selling the calls, or the more proper way to say it is to write the calls, well, they believe that the underlying asset, like the stock, will stay below the strike price when the option expires, or before the option expires. So you could say that the call option seller thinks that the market is soft or might go down a little bit. Now, with put options, buying one means you think the price will drop. And you'd likely want to buy put options to protect your portfolio positions. Well, yes, some people buy put options to speculate. They go long puts, and that's fine, but that's really for another video. Okay, so now that we discussed buying options, of course, there's another side to this pancake, and that's the person who writes or sells the put option. If you sell a put option, it means you're bullish because you think that the price is going to stay above a certain point. Now, if any of this is confusing, even just a little, I get it. It took me quite a while to understand the differences between buying and selling, puts and calls, and it can get confusing. So let's see if I can make an analogy. Imagine that a teeter-totter is like the stock market. On one side of the teeter-totter, there's the buyers of stocks, and on the other side, we have the sellers of stocks. When buyers of stocks are more active, the teeter-totter is going to be tilting towards the buyer's side, and this means that the stock price is going to go up. Now, when the stock sellers are more active, the teeter-totter, it's going to tilt towards the seller side. And, well, this means the stock price is going to go down. Now, when it comes to options trading, options traders can make money by betting on which side of the teeter-totter will be heavier. For example, a call option buyer is betting that the teeter-totter is going to tilt towards the buyer's side, like that the stock will go up. And a put option buyer bets that that teeter-totter is going to tilt towards the seller's side, meaning that they expect, a stock price to go down in price. Now, the option sellers, well, they have a completely opposite view on the market from what buyers think. And in doing so, the option seller receives a premium from the buyer for taking on this risk. All right, so now that you know about calls and puts and buyers and sellers, let's look at a fictitious stock. We're just going to say XYZ. Call option buyers believe that XYZ stock price is going to go up. Say you buy a call option on XYZ with a strike price of $100 and an expiration date of a month from now. Well, this gives you the right to buy XYZ at $100 a share at any time on or before the expiration date. And of course, you're going to do this if the stock goes up above the strike price. Now, call option sellers believe that the stock price of XYZ is going to stay the same or perhaps go down by expiration. Say you sell a call option on XYZ with a strike price of $100 and an expiration date of a month. Well, this means you're obligated to sell your XYZ at $100 per share to the call option buyer if they exercise their option. And that'll happen if the stock price rises above $100 by the expiration date. So you see, call option buyers believe that the stock price will go above the strike at expiration, and sellers think exactly the opposite. Now, let's look at put options. Put option buyers believe that XYZ's stock price is going to go down below the strike price by the expiration date. Say you buy a put option on XYZ with a strike price of $100 and an expiration date of, let's say, a month from now. Well, this gives you the right to sell XYZ at $100 per share before the expiration date. So even if the stock went down to $80 or $50 or went all the way to zero, well, you'd still be able to sell it for $100. Cool, eh? I mean, I think that's pretty cool. Now, finally, we have the put option sellers, and, well, they believe the opposite of the buyers. They think that the stock price of XYZ is going to stay above the strike price. Say you sell a put option on a stock with a $100 strike price and an expiration date of a month from now. Well, this means you'll have to buy 100 of XYZ stock at $100 a share from the put option buyer if they exercise their option. And that means even if the stock price is trading for $80 or $50, you still have to pay 100. So there you have it. Buyers and sellers have opposing views, and call and put options allow buyers specific rights to do different things. Now, on to our actual strategies. There's two main ways to protect your portfolio using options, or even a single stock against significant price drops. And those are the protective puts and a caller. So we're going to start with a protective put. This is probably the easiest strategy to understand, as it involves buying a put option for every 100 shares that you want to protect. The protective put acts exactly like an insurance policy for your stock positions, and like any type of insurance, you're going to need to pay a premium for it. Think of your car, right? It's insured for things against like fire, theft, and crashes. Well, a put option also protects your portfolio against a stock crashing below a certain point. Now, like I said earlier, put options, well, they're a bearish position. So if the asset price drops below the strike price, you'll be holding what we call an in-the-money option. And that means it's going to have built up some intrinsic value. Now, that either means you can either exercise your rights or close out the trade by selling the option for a profit without selling your stocks. The gains from the put options will offset any paper losses in the underlying stocks that you have. So if the underlying asset's price plummets and you decide to cut your losses, the protective put caps your losses at the strike price. And the beauty of using options to protect your portfolio using a put option, well, you get to decide if you want to exercise it or not. So now you might say that, doesn't a stop loss do the same thing for free? Well, kind of, but here's the thing. Stop losses automatically trigger once a set price is reached. And there's no guarantee that you'll even get the stop price. You could easily get a lot less, especially if the stock is crashing fast. Now, with a put option, the strike price is what you could sell the stock for, period. No more, no less. Now, the best use of protective puts are when you think the stock price will likely go up in the long term, but you want to protect your position from sudden short-term price drops. And this is common, especially if you might need to sell the stock soon, you might need the money soon, or if you're trading on margin and you're at risk of a margin call. Now, you can buy protective puts with different durations, like weekly, monthly, quarterly, or even yearly expiration dates. Just remember that the more time that the option has, the more protection you're going to have for downside protection, but the more expensive the premium will be. By the way, if you want to know more about protective puts, I actually created an entire video about them right up here. Okay, so there's two main ways to use protective puts. Let's look at a stock that's experienced a recent price drop. By the way, for this video, I'm using barchart.com, which is one of my most favorite financial data providers because, well, it's easy to use, and I usually find that they have exactly what I need quickly. Anyway, I found a likely candidate for our protective put option here, and that's TransUnion, or TRU. As we can see, the stock just crashed after missing its earnings estimates. We can see here from the chart that TRU closed at $64.85 yesterday. Then today it opened at $55.54 today and just kept going down to $47.70. If you had bought 100 shares of the stock for $65 a few days ago and woke up to the current price of $47.70, well, you'll have a $17.30 unrealized loss per share in your account, or $1,730 total. And once you sell, this unrealized loss becomes an actual loss. But what if you had a protective put in place? Well, let's break down the two ways a protective put option can protect your TRU shares. So let's say you bought a put at the same time you bought the stock. Say you paid $65 a share. Then, say you decided to buy a put option that has a $63 strike price and expires in 3 months from now. And for that, you paid $2.50 as a premium, or $250 total for the contract. And like with the earlier example, you wake up this fine Tuesday morning and you see that TRU's stock has crashed. So you decide to exercise your put option. Now remember, owning the put option means you'll have the right to sell 100 shares of TRU for $63 regardless of how low the price goes down. Your total losses would then be $450 total. And to calculate that, you find the difference between the strike price and the purchase price minus the premium you paid, multiplied by 100 for every contract that you use to cover your shares. So yes, the loss was $450. It's kind of annoying, but the protective put insured you from potentially losing even more, so $1,730. Now, if the price of TRU remained above the $63 strike price until expiration, then your protective put expires worthless. And don't forget, the premium you paid for the put option is going to impact your break-even price if you ever sell your shares. To compute your break-even price, you're going to add the purchase price and the premium you paid, which in this case is now going to be $67.50. Another great thing about protective puts is that it doesn't cap your earnings, so you can participate in any upward price movement, even if the stock goes to $100, $200, $500, has no bearing on it. All right, so in the previous scenario, I discussed exercising your rights and selling the stock. But what if you didn't really want to sell your stock? Well, your rights are your rights, and it's not something you're obligated to do. You don't have to exercise them if you don't want to sell your stock. So using the same example, you purchased the stocks of TransUnion for $65, and then the price crashed to $47.70. That means that the $63 put option, or the $63 strike put option, now has what we call intrinsic value. And for a put option, intrinsic value is the difference between the strike price and the current stock's price. And in this case, the intrinsic value would be $15.30. Now remember, you only bought the stock and put option a few days ago, and your option has a 3-month expiry. So it still has time value, and this is what we call extrinsic value. Extrinsic value is the portion of an option's price that goes on top of an option's intrinsic value, if there is any. It's influenced by factors such as time until expiration, volatility, as well as interest rates. Interest rates have been going up, and that's also affecting the extrinsic value. So what does this all mean? Well, your option will probably be worth a lot more than $15.30, since there's still a lot of time value remaining, there's still volatility, and interest rates are still a crapshoot. So maybe you get an extra dollar for that, and if you did, your option would be worth $16.30, and you can sell it and keep the shares. And since you can sell your option for $16.30, your loss is now limited to just $3.50. How cool is that? Now, since you're still holding the stock, don't forget that you still remain exposed to any further downward price movements. And if you sell your put and keep the stock, well, you'd be able to do this if you believe the price has bottomed out and will go up at least eventually. By the way, if you want to know more about the differences between intrinsic and extrinsic value, check out this video up here. All right, so now that you understand how protective puts work, we have to figure out which option to buy. Now, this is going to be a bit of a balancing act. Remember the teeter-totter? Because the closer the strike price is to the stock, the higher the premium is going to be. So when you look at buying protective puts, you want to weigh the costs. Think of it this way. Ask yourself, what do you want to protect yourself against? Any losses from the stock's current trading price? Or could you accept a 5% loss? Or could you accept a 10% loss? Or a 20% loss? Now, a put option that protects you beyond a 20% loss is going to be much cheaper than one that protects you against a loss of over 5%. There's also another thing that you need to know, and that's what your chances are that the option will expire worthless or profitable. And we find this information in the options Greeks. And in particular, this one is going to be called the delta. Delta tells us how much an options price, or the premium, will likely move for every $1 change in the price of the underlying security. But it's also a really good indicator of the chances that the option is going to be profitable or not. Let's look at another example. In this case, we'll take Johnson & Johnson. It closed at $151.57. Say you own 100 shares of it, but you want to protect your portfolio position against a crash. And you can do this by buying a put option. All right, so here's what put options are currently trading for. This is the options chain. Now have a look at the $150 strike price. It last traded for $348 a contract. So with that, you'd get protection for 100 shares of Johnson & Johnson below $150. But take a look at the delta. It's minus 0.41. In this case, it means that there's about a 41% chance that the stock will move below $150 by expiration. Don't believe it? Look at the $105 strike price. It shows a 0% chance. And see this one? The $200 put option strike shows a 94% chance that the stock will be below it at expiration. Bottom line, for a protective put, you'll want to pick an option with a strike price below the stock's current trading price. But for how far? Well, that's going to depend on your risk appetite and how much you want to spend. So now that we know what protective puts are and that they're a kind of insurance and insurance costs money, but what if I told you a way that you could protect your portfolio using options without even paying for it? And this is known as a protective collar. Now, the collar strategy is a two-legged strategy. It's a protective put combined with a covered call. Some people call it a hedge wrapper. Now, to set it up, the trader sells a call option on a stock that they already own, and this is the covered call, and uses the premium from the option that was sold to purchase a put option. The combined position results in the trader limiting the upside, but protects it from the downside. And the biggest benefit of a collar is that it's a very low or zero cost hedging strategy. In fact, in some cases, a collar can even turn into a credit that you get to keep. Let's say, for example, you own 100 shares of Procter & Gamble, and you're worried that the stock might crash. But at the same time, you don't want to pay any money to protect this position. Well, in this case, you can use a protective collar, and here's how it would work. First, let's have a look at put options that are expiring about 6 months out from now. Now, Procter & Gamble is currently trading for $150.60, and we'll assume that you bought 100 shares today for that price, $150.60, and you want downside protection beyond 10% below the last trading price. So let's say around $135. So we'll pick the $135 strike price. This is the options chain for Procter & Gamble puts expiring 6 months from now. Of course, that's from when I recorded this video. And you can see that the $135 strike price put option last traded for $290 per contract. Remember, each contract covers you for 100 shares, so bar chart's listing it at $2.90. The $135 strike put protects the stock from any price movements below $135 up until the expiration date. Now, let's say you don't want to pay $290 for the put option. What do? Well, you could sell a covered call and use that premium to pay for the put option. Now, remember, a call is an option that gives the buyer the right but not an obligation to buy shares from you at the strike price at any point until expiration. The fact that the call option is covered means you already own the stock. And here we have the call option chain for P&G with the same expiration date as the puts. So remember, we paid $2.90 for the put option, and we want to sell a call option for around the same price. That way we don't pay anything, or we pay only a little for that call option. In this case, we can see that the $165 call last traded for $2.75, and that's about the same as what it cost for the put option. But here's the thing, have a look at the delta. There's only a 27% chance that it'll be profitable for the buyer. In other words, there's a 73% chance that Procter & Gamble won't rise above the strike by expiration. And if it doesn't, the option expires worthless. I mean, the holder can always assign at any time, but hey, even if they did, you'd still sell your shares for $165 each, almost $15 more than what it's worth today. So, let's look at the possible scenarios that could happen. For a protective collar, the only thing that you only really want to pay attention to is the stock price, especially if you want to keep your stock. Both options will be out of the money if P&G's stock ends up trading between $135 and $165 at expiration. If Procter & Gamble's price stays below the covered call's strike price, the option expires worthless. If the put option expires out of the money, well, you'll be happy because you didn't need the insurance. The best thing is you can do this trade again and again, as many or as little times as you want. If Procter & Gamble trades above the $165 strike price, now you're at risk of assignment. And that means the holder could require you to sell your shares for $165, the strike price. So yes, while protective collars are awesome, there is a trade-off. Your profits, or your potential profits, are now capped. Let me explain. Your short call's strike price is $165, right? So if P&G moves up to $170 within or at expiration, your call will likely be assigned and you'll sell your P&G shares for $165, which means you're still going to make $14.40 a share minus the 15 cents it cost you to get into the collar, bringing you a total profit of $14.25. But the bottom line is you'll lose out on the extra $5 per share because of the collar setup. Now, when markets are erratic, you can't really put a price on the kind of peace of mind, right, that protective collars bring. So let's explore what could happen when the price of the stock goes the other direction. Now, if P&G's stock crashes, let's say to $120, your protective put becomes into play and you're going to have two choices. You can either exercise your put option and sell 100 shares of P&G for $135, or sell your put option that's now in the money by at least $15 and you get to keep your stocks. Now, if you decide to exercise, your total loss will be $15.75 a share, calculated by using this formula. You take the put strike minus the purchase price and add or subtract any premium that you earned or paid. But remember, this could have been a $30.60 loss per share if you didn't have a protective collar set up. Now, say you want to sell your put option, right? You see it's profitable and you want to keep your stock. You're happy with it. Well, if you think that P&G is going to bounce back, well, you can just sell your put option and the money that you receive will offset any paper losses that you have on the stock. Now, we can't know for sure what the option will be worth before expiration, but at expiration, a put option with a $135 strike and an asset that's trading at $120, well, it means it's in the money by $15. So you're going to get at least that plus any extrinsic value that's remaining. Again, you still get to keep the stock, so remember that you're exposed to any further upside as well as downside movement. So there you have it. Protective put options offer you protection or a form of insurance while allowing you to participate in any upward price movement. And in exchange, you're paying a premium. Protective collars, though, on the other hand, they give the same kind of protection, and they're subsidized by selling the call option. That means that you can get about as much as you paid for the put option or more by selling a call option or the covered call. But the trade-off there is that you limit your potential profits. Now, whichever you pick, option strategies like protective puts and collars, well, they offer excellent risk management and portfolio protection. Feel free to use any of these two strategies to fit in with your risk tolerance and investing objectives. And of course, feel free to paper trade with it to get, to hone in your skills. And remember, you don't have to trade with stocks or options blind. Tools like bar chart, well, they give you the best chance of being profitable. So that's what I've got for you today. Remember to like or leave a comment for any questions, or of course any future video suggestions. In the meantime, I thank you so much for watching, and I'll see you in the next video. Bye.